Artificial intelligence is obviously one of the hottest topics on the market today, and there's no doubt that companies like Nvidia are growing like absolute crazy as Microsoft, Meta, Alphabet buy hundreds of thousands of artificial intelligence chips, H100s, eventually H200s and B100s. There's billions of dollars being invested in these chips, and we still don't know what most of the business models are going to be behind artificial intelligence. I think that ultimately makes AI itself and investing in AI very risky. Whether you're investing in companies that are building models or data centers or applications, it's very possible that we are in an AI bubble. But there is an area that I think is going to have long-term tailwinds, and that is energy consumption. All of this artificial intelligence work takes a ton of energy to complete. Today, data centers are about 1 to 2% of the energy usage in the world. That could multiply, putting a huge strain on the electric grid and requiring billions of dollars worth of investment in new energy infrastructure. So I think if you're interested in artificial intelligence, but maybe you think AI stocks individually are a little bit too risky, one way to play this industry is just by buying energy companies that are going to be providing the energy and services that a lot of these companies need. So I'm going to go through some stats behind this and a few investment ideas for you today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's try to put some of these AI growth into context. There are a number of places that have tried to quantify what the opportunity from an energy perspective is for artificial intelligence. And we're so early in this investment phase that I don't think we can really quantify what it is yet. And the crazy thing with AI is that we're growing by orders of magnitude. But hopefully this gives a little bit of context to what exactly is going on here. So this is an article from Scientific American, and they estimate about 1 to 1.5% of global electricity use. And that's based on data from the International Energy Agency that goes to operating data centers. And this is from a few months ago. This is from October 2023. But they're anticipating if NVIDIA can ship 1.5 million AI servers in 2027, which I think is probably underestimating the amount of growth that NVIDIA is going to have in artificial intelligence, that could consume 85.4 terawatt hours of electricity annually. To put that into context, this is the US electricity profile. This data is a little bit old because they take a little while to get this information out. But I've just picked out one state here. This would be like adding the amount of demand that the state of Missouri has. So artificial intelligence alone could account for as much electricity consumption as the state of Missouri. You'll see in a lot of places that they're talking about AI energy usage being the consumption of a small country. And I think this sort of puts that into context. This is an article from Tom's Hardware that estimates that each H100 GPU consumes about 700 watts of power, which is going to be more than the average American home. And we may see that energy consumption go up as NVIDIA moves to the 3 nanometer chips, which are going to be in the B100. They're also looking to increase the amount of chips that they're selling in future years. And these existing chips aren't going to go anywhere, so they're going to keep compounding their energy usage. And just to put the consumption numbers into context, Meta said that they had about 380,000 H100s and about 600,000 H100 equivalents. So Meta alone, from an AI generation perspective, is probably getting near about 1 million homes worth of energy consumption just for some of their AI chips. Now, to put some of this growth into context, in the US, electricity consumption growth has been between 1 and 2% for about a century now. So this is not an industry that is used to growing at 3, 4, 5%. So if we're adding a Missouri worth of electricity demand in a relatively short period of time, that's going to put a ton of strain on the electrical system. So you're going to have more distribution. You're going to need to build more generation. There's a lot of different assets that are going to have to be built, probably in close proximity to the data centers that are doing a lot of this work. So a ton of infrastructure that's going to need to be built. And think about on top of this, on top of the potential electricity demand from artificial intelligence, you have growing sales for electric vehicles. Even though that growth has maybe slowed, we're producing more and selling more electric vehicles this year than we did last year. So there's going to be more demand from an EV side on the electricity grid. So all of this added together means that there's going to be a tailwind of demand for the electricity market, and there's a number of ways investors can play that. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The electricity market is primarily split into two segments. There's regulated utilities and then unregulated utilities. So unregulated utilities are typically selling energy to a regulated utility or to an individual company. So NextEra Energy Partners is an example of that. Brookfield Renewable Partners is an example. A lot of utilities actually have an unregulated arm that is doing a lot of their investment. On the regulated side, this is where you're going to get the assets that you probably see every day, the power lines that are throughout each city, the transmission lines. A lot of the generation is owned by a regulated utility. So some examples there, NextEra Energy, the parent company of NextEra Energy Partners, is a regulated utility or owns a regulated utility. So there you have basically two ways to play the market with a family of companies, if you will. You have companies like PG&E in California, which is one of the biggest utilities in the country operating in that San Francisco area. So Silicon Valley probably going to have a lot of demand for PG&E electricity. Xcel Energy is another example, much more Midwestern company, Midwest and then Colorado, but primarily a regulated utility and then also builds assets on the unregulated side as well. So I think there's going to be massive tailwinds for all of these companies, and they're all going to be competing to build out projects to expand their asset base, which is what regulated companies want to do. And if there's growth in electricity demand, that's exactly what they're going to do and how they're going to make more money long term. But I think the bigger opportunity may actually be in companies who are selling the assets that are going to have to go in the ground. And some of these assets are going to be constrained. So if you look at a lot of the tech companies that are building out a lot of these data centers, one of the things that they include oftentimes is renewable energy assets. These are either connected to the data center or they buy through a power purchase agreement, and then that power flows from wherever the renewable energy power plant is through the electricity grid and then to the data center. They don't necessarily directly use the electricity, but they're using it on a net basis. And this is where you're going to see demand for companies like First Solar's solar panels, primarily a utility scale power plant builder on the solar energy side. You're going to get demand for products like Array Technologies. On the wind side, you have companies like General Electric and their renewable energy spinoff, which is happening relatively soon, and Vestas. That is a wind energy company. So providing the actual assets that a lot of these renewable energy asset owners are going to put in the ground. And then you get to the battery side as well. I think there's going to be a lot of opportunity to store energy so that these data centers can use it on an as needed basis. Now, Tesla is obviously the biggest name in energy storage that you probably heard of, but there's companies like STEM, which are working to try to control the energy and actually deploy it to the correct place in a commercial setting. AES is a company that has done a lot of this work. And then you have asset owners in storage like NextEra Energy Partners. So there's a lot of different ways to play this market. But I think the general theme for investors is there's just going to be tailwinds behind all of the energy market. So the kind of assets you're going to want to look at are renewable energy that can be built relatively quickly and sited near a source. So that could be wind, solar, and energy storage. Hydrogen could potentially play a role. We've seen them be attached to certain data centers, but I don't know that that's necessarily going to be a way that a lot of these companies are going to go as they build out their data centers. The other thing is that I think we're going to see massive tailwinds behind just utilities in general. So owning a basket of utilities or a utility ETF could be a phenomenal way to play the market, whether you're looking at regulated utilities or unregulated utilities. So the secret here is that artificial intelligence and electric vehicles too are going to use an absolutely astronomical amount of energy. And if that demand is going to be met, we're going to have to invest a lot more in the industry than we have for decades. A lot of this investment has actually slowed in recent years, and with higher interest rates, it's making it harder to justify a lot of these investments. So a lot of these tech companies are going to have to put a lot more money into energy consumption, and that's a huge opportunity for investors. So which energy stock do you think is your favorite right now? I think if I was going to pick two, it would be NextEra Energy Partners, which is an asset owner, phenomenal dividend. I think could have a lot of long-term tailwinds. and First Solar. I think the tailwinds behind the solar industry, and especially the utility scale solar industry, are going to continue for years, and First Solar is absolutely the leader there. But which ones are your favorite? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.